While much of the world was celebrating the new year, stress began leaking through the plumbing of the financial system. At 9:30 p.m. Eastern on December 31st, a rapid sequence of trades hit the silver market, erasing roughly 5% of its value in under an hour. Most commentators are calling this routine year-end profit-taking. That explanation is intuitive. It is also incomplete. Because at nearly the same moment silver sold off, the Federal Reserve's transaction log showed a sharp spike in overnight repo activity, well above recent year-end norms. You are being told this was ordinary housekeeping. My analysis suggests it was emergency liquidity. The claim I'm testing is simple. The silver sell-off and the repo spike were not independent events. They were likely two sides of an urgent attempt to manage a collateral problem before the regulatory clock hit midnight. This doesn't require a conspiracy, it only requires incentives. Every major bank faces a hard reporting deadline at year-end. Capital ratios, leverage, and risk exposure are captured in a snapshot used for regulatory scoring. If a large position is deeply underwater at that moment, the consequences are immediate. Higher capital requirements, scrutiny, and market punishment. The incentive is not to fix the problem in one night. The incentive is to make the snapshot survivable. This practice, known as window dressing, is legal and common. Institutions temporarily reduce risk, raise cash, and smooth their books. What stood out here was the speed. A double-digit dollar move in silver in less than an hour is not gentle de-risking. It has the signature of a forced maneuver. But forced selling requires liquidity. That brings us back to the repo market. Year-end repo activity always rises. Cash becomes king. But the magnitude and timing of this spike raise a forensic question. Was this broad system liquidity, or was a specific counterparty under pressure? If a major participant was liquidity constrained, holding assets but unable to raise cash fast enough to meet margin calls, the Fed's repo window is the only place large sums can appear instantly. The sequence matters. Silver pushes into a stress zone for short positions. Repo usage jumps. Heavy selling hits the futures market. Prices collapse. The snapshot is taken. The books look cleaner. If this were just profit-taking, margin requirements wouldn't need to rise. Exchanges raise margins when they fear counterparty risk. Higher margins force smaller, leveraged players out, adding sell pressure and liquidity, exactly what a stressed short position needs. At the same time, physical markets told a different story. While paper prices fell, physical premiums in parts of Asia and the Middle East remained elevated. That divergence suggests the selling was concentrated in derivatives, not in the movement of actual metal. So what happens next? Window dressing buys time, not solvency. If the move was purely tactical, the pressure should ease quickly once the calendar turns. If not, the stress will reappear. I'm watching three signals. First, repo roll-off. If the liquidity surge disappears within days, it supports a reporting-driven event. If elevated repo usage persists, the problem is ongoing. Second, open interest. A sharp drop would indicate shorts exited. Stable open interest would suggest the position remains, merely masked. Third, price behavior. If silver reclaims higher levels and holds, suppression failed. If it continues to sink, then the selling pressure is real, and this thesis is wrong. This isn't about predicting a single candle. It's about recognizing how fragile a leveraged system becomes at reporting boundaries. For 1 hour on New Year's Eve, price discovery appeared secondary to regulatory survival. The institutions made it through the night. Whether they make it through the week is the real test.